Welcome to A Few Minutes with Peter Grandich. I'm your host, Al O'Grady, and for the next few minutes, we'll be talking to Peter, getting his insights on the markets, commodities, business, politics, sports, and life in general. Peter Grandich is the editor of the Grandich Letter, which was first published back in 1984. He has been a market strategist, portfolio manager of 4 hedge funds, a mutual fund that bared his name, and is widely known for his accurate forecasts and no-hedge markets perspective. He appears regularly on television and radio and is widely quoted in leading financial publications. He's also the co-founder and managing member of Trinity Financial Sports and Entertainment Management Company, an insurance and estate planning firm specializing in servicing professional athletes and entertainers. Peter, as always, welcome back to the program.
Good to be back, Al.
Okay. Peter, when you're laying it on the line with forecasts like we do on each of our shows, you have to take the good with the bad. We'll talk about a bad forecast at the end of the interview, but let's start with the good ones. For starters, you've been noting at the start of this year that the least resistance is up for the U.S. stock market, and it comes as no surprise to see the market at an all-time high. Despite lots of bad news, the market is at its highest point in quite some time. Do you feel it can make an even greater all-time high?
Yeah, well, we're not quite back to the all-time high yet, but we're certainly within striking distance. And while, again, I want to emphasize I have not been a roaring bull on an expectation of something like a 3 or 5 year new, secular bull market, but I do want to point out that so many people, particularly in the hard asset camp, have just constantly called for the U.S. stock market to come down. I got emails again today about people, sending me the latest comments from, people who've been quite bearish for the last few years and really have gotten their heads handed to them. And I operate under the fair assumption, because I believe it's true, that there's a don't worry, be happy atmosphere on Wall Street where the vast majority of people are tilted to the bullish camp. And it's very hard to defeat that camp. You really have to have an ongoing and serious situations, which from time to time we've had. But it's been my belief that the stock market has too much momentum and too many friends at the moment, especially in the Fed, to expect a large-scale retreat, and that the surprises would continue to be the upside. And I think that's pretty much the case through the election, with the one caveat, and that is a caveat that I have spoken about and written about, and no one knows for sure when it will be, although I believe it's when, not if, and that is a very serious military conflict takes place at least between Iran and Israel, and may or may not include the United States, at least at the start. And it would be shocking not to see the market sell off on that news initially, but outside of that, I just don't see anything that's going to drive the U.S. stock market substantially lower anytime soon.
Do you think it's based on false hope? In terms of, let's start with the fundamentals. Do you think it's making sense for the stock market to reach these highs based on based on business fundamentals right now?
No. And to understand and appreciate, I'm a believer by this time next year, what has been underway in Europe will take hold here in the U.S., and people will realize that the U.S. is basically, close to bankruptcy, is indebted up to their ears, can't pay it back, is going to have to do restructuring, et cetera, and we will go through a period like we've seen in Europe. So that's why I don't believe the stock market is gearing up for, a long multi-year rise. However, and I hate using those words like however, because without them some people can't speak in our business, but the fact is that the market has risen when most people felt it should have fallen, and it's just kind of like an analogy when everybody's predicted a boxer didn't stand a chance and he gets banged around, but somehow in the 12th and 13th round he's still there. More times than not, he ends up winning, and that's what's happened now. And part of that it also is that because of that don't worry, be happy atmosphere, most of those folks who are in charge of most of the money that's in the market is always looking to put it to work because they make money that way. So it's always usually just divided between stocks, bonds, or cash. And the bond market has come so low in terms of yield that it's very difficult for them to keep throwing money at the bond market. So by default, the stock market is seeing a lot of that capital, and that's given the underpinning to the market. And with the Fed still their friend and not their enemy, the least resistance is up. And I think it will continue that way into the election. And the only thing that may knock it off for more than a day or so is the conflict in the Middle East and perhaps getting worse than some of us think it can be right now.
You touched on a key point, the election, with the market reaching near an all-time high, as you mentioned. This has to bode well for President Obama and the Democrats.
Well, I'm just amazed. I have to tell you something. I mean, it's clear and evident that anybody reads or follows what I have to say is that I'm a staunch conservative, but I'm amazed of the inability of Romney and the Republicans to just not be able to just go up there each day and say, listen, this is what the guy said 4 years ago. This is what's happened. And instead, despite, again, last week, poor employment numbers, we see that, I think Romney is trailing, based by the latest polls and all that type of stuff. And so it would come as no surprise. It would be, I think, detrimental, but I also think it could benefit some of the markets that I am bullish on, particularly gold, that if actually Obama wins. But I still think we can't really say that until we get much closer to the election, because there's still enough time for either a continuous slip in the economy or somewhat of a rebound. And so I think the window's still open, but I think the Republicans have blown their chances to demonstrate are you better off today kind of feeling. And instead, through disingenuous comments, the Democrats have been able to push aside dealing with facts and instead have created, a sense that something is actually better than it really is.
Okay. You said a number of times that it's not how much one makes in investing, but how much one avoids losing. One place where a number of investors were certainly losing their shirts was by shorting U.S. bonds. You avoided that until such time that the 10-year U.S. Treasury bond was down to a 1.44% yield. You also said you wouldn't jump in big time until the yield fell to 1.25%. Is that still the case?
Yeah, I'm still, optimistic and hoping, or a combination of both, that we can see through a Fed easing, people drive the yields down to about 1.25%. At that time, I just think it would be perhaps the biggest, if not best, bet that I would make in 30 almost years of investing against the bond at that time. I think the Fed has all but signaled, and the employment numbers are giving them room to do it, that they are going to go through whatever you want to call it, a QE3 program or quasi-QE3 program. And with that, we could see that one last rally in the bond market. But having an initial short position in case we don't go that low is good. But like I said, I just don't see how 10 years from now, if I buy a Treasury even at today's 1.66%, knowing what inflation is, my purchasing power is going to be a lot less. So that's why I think bonds are a total void for at least the next decade.
Yeah, I understand the theory and everything that you're saying, Peter. But I mean, if the yield is 1.25% and you're going to short something, you're only making money if it goes down. How much lower can it go below 1.25%?
No, not if you shorten the bond. If you shorten the bond, you're actually, the higher the yield goes, the more money you're going to make if you shorten the bond market.
Yeah, I always get that. Yeah, that's right, because the price
is inverse. Since last Wednesday night, that's your problem. You haven't come down yet.
That's true.
Celebration, so yep. I'll forgive you.
Okay, well, thank you very much for that. Obviously, I stuck my foot in my mouth on that one. Let's move on to the next topic of discussion. You've also been going against the crowd with the U.S. dollar. A lot of people were saying it was in a new bull market, but you continued to say it was terminally ill. You also said that it was time to short it if and when it rallied up to the 83 to 84 area on the U.S. dollar index. It has done that, making it a contrarian's dream in your view. Now, another surprise is the euro, rising above $1.25. That has all sorts of ramifications with the dollar and also with gold. So, first, what's your take on the dollar?
Well, it's never really changed. A couple of years ago, I stated and made a dramatic change in my own personal finances by moving out of the dollar and actually into the Canadian dollar. but it's, in my view, it's terminally ill. It's on a long-term secular bear market that was going through nothing more than a dead count bounce. And if the bounce got to the 83, 84 area, it would be an opportunity to short it. I noted several weeks ago that the bullish camp based on foreign currencies futures markets had something like a 96% bulls reading on the dollar, and that the surprise, despite all the bad news of the euro, I thought was going to be that the euro could rally above 125 against the dollar, and when it did, we'd see a strong short covering rally in both it and the gold market, and both has occurred. I continue to believe that the U.S. dollar will come under substantial more pressure and make new lows in the dollar index once the scenario that I painted earlier about the debt crisis coming to America that's currently in Europe takes hold. So I just don't see any reason to be bullish on it, particularly since I believe eventually the bonds yields will go up no matter how bad the economy is doing, and we will have a credit crisis here like we saw in Europe. So I think avoiding the U.S. dollar is probably one of the better things people can do. And like I've said for myself, outside of metals, I've looked to Canada as my place to own paper currencies, and I still think places like Canada and Australia are alternative choices combined with physical gold versus being in the U.S. dollar.
Any correlation between a well-performing stock market and also the dollar, or no correlation whatsoever?
I think a lot of those correlations that used to work 10, 20, 30 years ago don't, because of the changes both in the world economics and in financial markets. They don't run the same way that they used to 20, 30 years ago. That's part of the surprise and why I think the dollar has done so poorly, because we have not seen big money flows into the U.S. dollar despite all the crisis in Europe. I mean, if you look at it, how all these gold perma bears should be slapped around, because if there really was going to be a very bad gold market, we would have seen tremendous money flows into the U.S. dollar, and we've never seen it. So it's one of the reasons, that I maintain a very bearish stance towards the dollar and a very stance towards gold.
Right. Now, I mean, traditionally, the U.S. dollar has always been the currency of safe haven. Is that really, is gold really becoming the currency of safe haven?
Oh, I think it is for people outside North America, and that's what I've always stated over and over again, that you have to look at the gold market away from North America. And if you do, and you look where real wealth is, particularly in Asia, money flows into gold versus the dollar extremely strong, and that's been one of the underpinnings that have given me so much bullish reasons to think that gold, still has to go a lot higher.
Okay, and let's talk more about gold. Peter, I'm going to pat myself on the back this time. I know you've been calling gold the mother of all bull rallies, and it's certainly doing that. It has been depressed, maybe the first half of this year somewhat. On our last interview, I was telling you that technical analysis was showing that gold was ready to break out any time. And guess what? It's starting to do that. Now, I know you've been really been putting your money where your mouth is. You were willing to bet $2 million that gold would be over 2,000 without ever going below 1,000. As I said, the last week or so, gold certainly has been breaking out. Is this the next leg up that you've been forecasting for some time?
Oh, yeah, it is. It's likely to consolidate here, and it'd be healthy that if we actually pull back a little, or at least don't keep going up over the next few days, or at least the next few hours, and consolidate these gains. But it's a market that's, that's why I call it the mother of all bull markets. It's a market that remains extremely strong, and very important to go back and look at not only what the classical perma bears were saying when we were in the 1530s and 1550s, but look how many people who were bullish, who pulled in their horns, or actually switched camps. And yet the market never broke down. It consolidated. It was something that I always felt it was, just an intermediate correction in a secular bull market, and now it's broken out again. And the surprises, I think, in gold will continue to be to the upside, albeit we will get the classic hourly or daily raids that last for a few hours or a day or two from the bears, but outside of that, the gold market and the silver market are pointing substantially higher over time.
Any sort of forecast prediction you like to say, a certain target and also a time frame?
I just, like I said, I think now more than ever, I've said for a long time, this gold market can't possibly end until it has a 2 in the front, which means it has to be at least 2,000. If it takes 3 weeks to come or 18 months to come, the fact that it's coming without much of a decline is reason to stay very, very bullish on gold.
Fair enough. Finally, I assume no change really on the oil and natural gas fronts?
No, still, think oil will get over $100, and there's still no reason to run out and be long natural gas at this time.
Okay. Now, before I speak about where you badly went wrong with one of your forecasts, any individual companies that you'd like to talk about?
Well, again, I think the junior market, like I said a few weeks back, seen its worst. I don't think it's going to fly here to a point where it makes up all the losses it's had, but the worst is behind us. I do think, in everybody's book, mine is a prejudicial book because not only am I compensated by the clients that are listed on my website, but I own stock in most of them, some very large. And with that in mind, I'll look at, I think people forgot what it is to be in the beginning of a major discovery company. I think North American Nickel is that. I think North American Nickel, who's gone elephant hunting in Greenland, has found where the elephants are, and hopefully now can find a good herd of them. And so I think that's an interesting play. Obviously, my biggest bet ever in terms of dollars towards any one company is currently in Aurum and exploration. I think it's self-explanatory. People can go to my blog and read what I've said about it. And, I just think there's some companies that may not be very sexy at the moment, but they've also de-risked their future a lot. I think two that fall into that camp. One is Donna Metals, which is, soon to be a producer, and Spanish Mountain Gold, which I think is clearly indicating that the likelihood of them going into production is strong. And then I think the last thing that there's been an overreaction on to the downside are iron ore related companies. I have 3. I own shares in all of them. I most recently bought the large stake in Ridgemont, but I also work for and own shares in CapEx Ventures and Alderon, all of which I think are down at levels where even the most riskiest taker can speculate here with, I don't think, too much more downside risk.
All right. Well, I think that rounds out.
I got to go now.
No. We still have a few more minutes.
Okay.
I wonder what we can talk about now. Well, let's see. It was week 1 of the NFL. Oh, there was a certain team that beat the Giants. It was the Cowboys. How about them Cowboys?
Well, Al, the thing I liked about the Cowboys Wednesday night is they finally proved the theory that's been around for a while. The blind squirrel theory?
I have no idea what the blind squirrel theory is.
Well, even a blind squirrel can find a nut every once in a while. Hey, you know what?
What?
Do you know the last time the Cowboys won a playoff game?
Oh, it's been a few years.
Yeah. I think, was the internet just out yet when they last won the Super Bowl? I'm trying to remember. Were people on the internet yet?
I think they were.
Oh, early 90s. People. Yeah, that's right.
Yeah, okay.
Congratulations, Al.
Well,
won a game. I'm really happy for you because I know how happy it made you.
Well, thank you very much, Peter. It takes a big man to admit when he was wrong.
Yeah, I was wrong. I was so wrong I cried in my picture of my Super Bowl win from last year. That's what I did.
Yeah.
I'm trying to remember what I did.
Okay, that's good. Just kind of remember who has more Super Bowls, though.
Right.
Oh, okay. And he abruptly ends the conversation on that.
Modern era. Did you ever look up the words modern era? Okay.
Modern era?
You need to focus. Were they wearing face masks when the Cowboys last won? I'm trying to remember.
Oh, absolutely.
They were. Okay. Was it color? Trying to remember, was it color when you can watch when they played? Yeah, you're right.
It was also in high definition, too.
Yeah.
Yeah, cable TV was around as well.
Yeah, okay.
Yeah, we had the automobile. It wasn't a horse and buggy era. We had the automobile. Oh, thanks for having me.
All right, let's see in January what happened, okay?
Okay. Peter, as always, thanks very much for your time. I look forward to talking with you again very, very shortly.
Thank you, Al.
Okay. This interview appears on my website, corporateinterviews.com. It can also be accessed on YouTube and iTunes. Just type in Grandich in those respective search engines to not only access this interview, but interviews that we've done in the past. If you have any questions for Peter, by all means, send me an email. My email address, very simply, al@ corporateinterviews.com. We'll certainly do our best to mention it on our next program. For Peter Grandich, I'm Al O'Grady. Thanks very much for joining us.